Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about HK Electric Investments and HK Electric Investments Limited Annual Report. HK Electric Investments and HK Electric Investments Limited provide a wide range of businesses and services to meet the electricity needs of Hong Kong Island and Lamma Island. The company's primary operations include the generation, transmission, distribution, and supply of electricity through various power sources such as coal-fired units, oil-fired gas turbine units, gas-fired combined cycle units, solar power systems, and wind turbines. The company operates a large-scale transmission and distribution network spanning 47 kilometers, serving over 593,000 residential, commercial, and industrial customers. This extensive network enables the efficient delivery of electricity to meet the diverse needs of its customers. In addition to its core operations, HK Electric Investments also engages in financing activities, further diversifying its business portfolio. Overall, the company's comprehensive range of services and businesses make it a significant player in Hong Kong's energy sector, providing reliable and sustainable electricity solutions to its customers while also contributing to the country's economic growth. HK Electric Investments and HK Electric Investments Limited maintains a market capitalization of $60 billion, broadly in line with the industry peer group. HK Electric Investments and HK Electric Investments Limited trades at a higher price-to-earnings ratio of 19 times and a higher price-to-book ratio of 1.23 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 58% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 4.73%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth and decline can be identified from the extracted summaries. On the growth side, sales of electricity are the main contributor, increasing by HK $71 million. This indicates that the company's ability to sell more electricity is driving its revenue growth. On the other hand, the primary drivers of revenue decline include a decrease in electricity-related income and sundry income. These decreases amount to $3 million and $4 million respectively, indicating that these areas are contributing to the decline in revenue. It is worth noting that certain factors, such as changes in creditors measured at amortized cost and interest income on financial assets, have been deemed not significant drivers of revenue growth or decline. This suggests that while they may be affecting the company's finances, they are not having a major impact on its revenue. The net income of the company experienced an overall increase over the 2 periods analyzed. Initially, there was a modest growth of $38 million, 1.8%, from $3,111 million to $3,149 million. However, this trend continued with a more significant increase of $68 million, 0.56%, from $12,057 million to $12,125 million. Despite the net income growth, profit margins showed a decline. The operating profit margin decreased by 1.9% from 85.6% to 83.2%, while the net profit margin dropped by 1.6% from 71.3% to 69.7%. This decrease in profit margins may be attributed to various factors such as increased operational costs, reduced efficiency, or changes in market conditions. Interestingly, there was a notable exception in the sales of electricity revenue, where profit margins showed an increase of 1.71%. This anomaly suggests that certain business segments within the company are performing better than others, possibly due to specific strategies or market advantages. The company's financial performance has shown significant improvement in recent years. One key indicator of this growth is the generation of positive operating cash flow. According to the latest data, the company achieved an operating cash flow of $1,351 million in 2025, marking a notable increase from the previous year. This upward trend suggests that the company's operations are becoming more efficient and profitable, enabling it to generate substantial cash flows from its core business activities. The positive operating cash flow is a crucial metric for investors and analysts, as it indicates the company's ability to meet its financial obligations and invest in future growth initiatives. The company's debt level and interest expenses have undergone significant changes in 2025 compared to the previous year. In terms of debt level, there is conflicting information across different pages of the report. However, based on the most recent and clear data, it appears that the total debt has increased from $50.08 billion to $53.11 billion. This increase is attributed to a rise in interest-bearing borrowings, including Hong Kong dollar medium-term notes and United States dollar medium-term notes. On the other hand, net external borrowings and net debt have decreased, indicating a reduction in the company's short-term debt obligations. However, this decrease is not reflected in the overall total debt figure, which has increased. In terms of interest expenses, there has been a significant decline from $1,499 million in 2024 to $1,281 million in 2025, representing a reduction of $118 million. This decrease in net finance costs suggests that the company's interest expenses have decreased, despite an increase in total debt. Overall, while the company's total debt has increased, its interest expenses have actually decreased, indicating a more favorable financial position for the company. The management has provided an update on the company's outlook and strategy. As we transition from planning to implementation of our 2024-2028 development plan, we are focused on achieving key milestones that will drive growth and sustainability. A major goal is to increase gas-fired generation to 80% by 2029, which will not only enhance our energy output, but also contribute significantly to reducing carbon emissions. This strategic shift underscores the company's commitment to environmental responsibility while pursuing business excellence. The company's financial performance reveals a notable trend. One significant aspect of its operations is the payment of dividends to shareholders. According to official records, the company has indeed paid dividends, as explicitly stated on page 18. The amount allocated for this purpose was substantial, totaling $1,422 million, as documented on page 20. This decision to distribute a considerable sum to investors indicates a commitment to shareholder value and satisfaction. It suggests that the company's management is prioritizing returns on investment, recognizing the importance of rewarding loyal shareholders. That concludes the financial summary for HK Electric Investments and HK Electric Investments Limited. Feel free to comment below, and I will be happy to answer them when possible.